Hello friends, welcome to the channel Virtual Learners. Today we will discuss about Reserve Bank of India and its functions. Reserve Bank of India was established in the year 1935. RBI was established by the RBI Act 1934. The commission which led to the establishment of RBI was Hilton Young Commission of 1926. It was otherwise called Royal Commission on Indian Currency and Finance. E-Kuber is the core banking solution of Reserve Bank of India. Now let's move on to the functions of Reserve Bank of India. It is the issuing agency of currency notes. It serves as the banker to the government. It is also called as Bank of Banks or the lender of last resort. That is, if any contingency happens, it can lend to the commercial banks. It announces the monetary policy, that is the policy of the central bank of the country. Here it is Reserve Bank of India. It has a role in stabilization of inflation, stabilizing exchange rate of rupee, and it is the keeper of foreign exchange reserves of the country. So these are the functions of Reserve Bank of India. We have to deal in detail how it regulates the money supply in the economy. So that is concerned with the monetary policy of the Reserve Bank of India. One of the main functions of Reserve Bank of India is formulation of monetary policy. What is monetary policy? It is the policy issued by the central bank of the country. Here in this case, it is Reserve Bank of India in matters of interest rate, money supply and availability of credit. So it is through this monetary policy RBI controls the inflation in the country. Now let's move on to the measures taken by RBI for the credit control. We will look into the quantitative methods by which RBI controls the money supply in the market or economy. We will move on to cash reserve ratio, that is CRR. What is CRR? It is the specified minimum fraction of total deposits of customers which commercial banks have to hold as reserves either in cash or as deposits with the central bank. So what is cash reserve ratio? It is a specific amount of money that commercial banks has to keep with RBI as reserves. We have seen what is cash reserve ratio. It is the amount of money that the commercial banks has to keep with the RBI as reserves. Here, let's take an example. Let us assume that the total deposits of commercial banks be 100 rupees. Now, if cash reserve ratio is 4% as issued or notified by the Reserve Bank of India, then 4 rupees out of 100 should be kept aside in RBI as reserves. This is cash reserve ratio. Now let us check out with an example how this CRR can be varied so that the money supply in the economy can be varied accordingly. Let's take the example that commercial banks have 100 rupees deposit. Here Reserve Bank of India increases the cash reserve ratio to 5%. Now commercial banks have to keep 5 rupees out of 100 with the RBI and they have only 95 rupees left to lend to the people or to inject in the economy. So if CRR gets increased, then there is a considerable decrease in the money with the public because commercial banks will not have enough money to lend to the public. So when CRR increases, money supply in the economy gets decreased. The reverse thing happens when RBI decreases the cash reserve ratio. When CRR is decreased, what is the effect? Commercial banks will have to keep less amount of money as reserves with RBI and more amount is available with the commercial banks to lend to the people. So if CRR gets reduced, money with the public gets increased. So money supply increases. This is how CRR is varied. So there is another reserve ratio called Statutory Liquidity Ratio, SLR. This is the proportion of deposits that commercial banks is required to maintain with them itself in the form of liquid assets in addition to cash reserve ratio. So this ratio has to be kept in addition to the cash reserve ratio which is mentioned earlier, and this has to be kept with themselves. These reserves are kept in the form of liquid assets which are readily convertible into cash. That includes government bonds, government approved securities, gold and cash reserve. So in SLR, a portion of the funds is kept either in gold, cash or reserves with themselves, that is the banks. So this is not permitted for lending. So take an example that commercial banks have total deposits of 100. If RBI notifies that statutory liquidity ratio is 20%, then you have to maintain 20 rupees from that as reserve apart from the CRR which is mentioned, that is cash reserve ratio. So in SLR, if SLR is notified as 20, you have to maintain 20 rupees as reserves with themselves, that is the commercial banks, and only 80 is available for lending. So now let us check out how we can increase or decrease the SLR to increase or decrease the money supply in the market. Now let us consider an example. Here commercial banks have a total deposit of 100 rupees. Now RBI is stipulating an SLR ratio of 20% to be maintained. So commercial banks now have 80 rupees only to lend to people. So when SLR gets increased, funds of commercial banks to lend get decreased. Thereby amount with the public also gets decreased because lending by commercial banks will be decreased. So people will get less money. So this is how when SLR increases, the amount or the money that is circulated with the public gets decreased. Now we will talk about decreasing of SLR. When a situation arises that there is a liquidity crunch in the market or there is not enough supply of money in the market, what RBI does? RBI decreases the SLR. Now what will happen? If RBI reduces SLR to 15%, now commercial banks have 85 rupees to lend. Thereby people will be having more money because commercial banks will lend more. Thus if SLR gets decreased, money supply in the market gets increased. So this is the mechanism of controlling money supply in the market by reducing or increasing SLR. So let's move on to repo rate. What is repo rate? It is the rate at which central bank of a country lends money to commercial banks in the event of any shortfall of funds. So it basically is a rate at which the central bank of the country, here in this case it is the RBI, that lends money to commercial banks. So that rate of interest is called as repo rate. So repo rate is RBI lending money to commercial banks at a particular rate. So that rate is called repo rate. So let's move on to how it is regulated, how the money supply is regulated in the market by regulating repo rate. So if RBI increases the repo rate, what will happen? Commercial banks will borrow less because the interest rate is high. So repo rate is the rate at which RBI lends money to commercial banks. If the rate is increased, commercial banks will buy less amount of money or borrow less amount of money because the rate is increased. Thereby subsequently the amount which is reaching the public will also decrease. How? Because commercial banks would lend less to public. We have seen that if repo rate is increased, money supply in the economy gets decreased. Now let us check out if RBI reduces the repo rate, what will happen? Commercial banks will get more money because interest rate is less, which is provided by the RBI. So the amount of money which is borrowed by the commercial banks from RBI increases because of the reduced rate. Subsequently, commercial banks will lend more money to the people. Now in the economy, money supply gets increased. So this is the mechanism where RBI reduces the repo rate. So the funds will be available for commercial banks to borrow from RBI. Subsequently, these funds would be lent to the common people. Then money supply gets increased. So if RBI reduces the repo rate, money supply in the economy increases. Now let's check out for reverse repo rate. What is reverse repo rate? It is the rate at which central bank of the country borrows money from commercial banks within the country. So reverse repo rate is basically commercial banks lending money to RBI at an interest rate. So that rate is called reverse repo rate. Now let us check out what is reverse repo rate and how it can be varied so that the money supply in the economy can be varied. If RBI increases the reverse repo rate, what will happen? Commercial banks will deposit more money or give more money to RBI because it is the rate at which The commercial banks lend to RBI. So if reverse repo rate increases, what will happen? Commercial banks will have a tendency to deposit or give more money or lend more money to RBI, so that the lending to public gets decreased. In this way, money with the public decreases. I will explain it once again. If reverse repo rate increases, commercial banks will have the tendency to deposit or lend more money to RBI. Subsequently, what will happen? The lending to the public gets reduced. So in this way, money supply with the economy gets reduced. So if reverse repo rate increases, the money supply in the economy decreases. Now let us check, when reverse repo rate decreases, what will happen? If RBI reduces the reverse repo rate, then commercial banks will not deploy much amount of money in RBI because the rate is less. So they will lend money to the public. Hence money supply gets increased. We will see it once again. Here the reverse repo rate gets reduced. What is reverse repo rate? It is the rate at which commercial banks lend the money to RBI. So in this case the rate is less. So commercial banks will not deploy that much amount of money in RBI because the rate is less. Instead they lend to the public. Money gets increased or money supply gets increased in the market. If reverse repo rate decreases, money supply in the economy increases. Now let's move on to marginal standing facility, MSF. It is the rate at which scheduled banks can borrow funds for overnight from RBI against government securities to meet shortage of funds. So whenever there is a shortage of funds, commercial banks or scheduled banks can borrow money for overnight from RBI. This facility is called, or this rate is called, marginal standing facility. So how it regulates the money supply? If RBI increases the marginal standing facility, commercial banks will borrow less. So the amount of available with the public will get reduced. If RBI increases the MSF, commercial banks will borrow less from RBI. Hence the supply of money gets decreased with the public. Naturally, the money supply in the market gets reduced. In the reverse scenario, if RBI decreases the MSF, then what will happen? Commercial banks will borrow more money, hence more money will be available with the public. Now let's move on to open market operation. What is open market operation? This is the sale and purchase of government securities and treasury bills by RBI in order to regulate the money supply in the market. To increase the money supply, what RBI does? Here RBI purchases the bonds and thereby cash is circulated in the economy. That is, RBI purchases the bonds and cash gets circulated in the economy. In this way, increase of money supply happens in the economy. To decrease the money supply, what RBI does? RBI sells these bonds so that cash is collected by the RBI and bond is sold. This is the process wherein RBI regulates or decrease the money supply. Please do subscribe for more videos.